We're going to talk about financing today in the debt world. Gideon gave us a nice segue. Thanks again for all the panelists for coming in town. I know some of you are not local, so thanks again for coming in, and those guests that are here. And thanks to GSH and Lynn for having myself here today. My name's Aaron Moll. I'm with Berkadia. I'm local. Berkadia is a national firm, formerly GMAC, then Capmark. We are a direct Freddie Mac lender. We also provide debt solutions for our clients with life insurance companies, CMBS, bank, debt fund, kind of everything in between. In addition to that, we have an investment sales platform as well. And have enjoyed a great relationship with GSH on the both debt and sales side. So with me, if you guys wouldn't mind, just doing a quick introduction on yourselves, a little bit of about yourself, a little bit about your business.
Sure. My name's Bob Mattler. I'm with Green Portfolio Solutions. I've been in the commercial real estate world for about 35 years. About the last 10, I've been trying to help developers, building owners, and investors realize additional income on their properties through sustainability strategies with financing. And I'm doing that through PACE financing. Property Assessed Clean Energy is the biggest tool I'm using. PACE is now in 38 states, and it's a economic development law. It allows building owners to use this kind of in-between equity and debt real estate financing for upgrading their buildings or for placing capital where there's a shortage in the capital stack. PACE is the cheapest capital to bridge that gap for financing. And the only caveat is, one, you need lender consent, and also these financing have to go towards energy efficiency and or water conservation projects. Those are very broadly defined. It can be an elevator upgrade, it can be roof, windows, doors, insulation, and on the water conservation side, low flow toilets, domestic hot water, and then any renewable project. So PACE has become kind of the darling, and it's gaining a lot of momentum because it's half the cost of mezz and it's half the cost of private equity when you're completing your gap, or instead of CapEx, just do it now, because we've seen 20% increases in building costs just this last year. And instead of having to delay those upgrades, you can do them now with PACE financing.
Thanks, Bob.
Hi, I'm Alex Epstein. I'm back up again. I've already given a sort of brief intro to Lex. We're a real estate investment bank. We focus here at Lex exclusively on equity. So this is an interesting panel to be on that we're focused on debt. Although I will say I think there's a huge opportunity for Lex and for all owners of real estate as they're reconsidering their capital stack in this environment to be able to replace a portion of what would have previously been debt with equity provided by us. We've seen ourselves be able to play a key role in helping people rejigger their capital stacks to be more efficient in this rate environment. I also previously worked at a debt fund, so I am familiar with real estate debt and did not ever issue PACE financing, but worked with it before, and to your point, it is a spectacular product. But yeah, familiar with the debt markets, familiar with the equity markets, and happy to play a role in helping to solve the gap in today's world.
Good morning. I'm Daniel Malka. I work for Dwight Capital. We are one of the largest HUD lenders in the country. We also have a private REIT where we do our bridge lending out of. So we do multifamily and healthcare, ground-up construction, refinances, value-add, everything, all in between. A little bit about myself, 4 little kids and love sports. Excited to talk a little bit more about the debt and, what's going on here in this world today and how we can help.
Fantastic. Thank you again, gentlemen, for being here. To open things up, again, the word is out. Rates are up. The Treasury's been volatile, to say the least. SOFR has been climbing with the federal rate hikes, which is definitely impacting not only floating rate at basically a 1-to-1 ratio, but also the swap lenders that swap over SOFR, more of your bank financing and whatnot. Just to kind of open things up here, interest rates are rising. Bob, if you wouldn't mind starting, being in the PACE side of things, what are you doing differently today, and how is your firm reacting to the rate environment?
Yeah, good question. Because interest rates are up and inflation is kind of going through, also with building costs being up too, PACE is kind of growing from a niche product to more mainstream because it allows building owners and developers to pencil out their projects now. And also in Michigan, in our state, we have a 3-year look-back provision, which means if you upgraded that building within the last 3 years and you put in a new roof or a new HVAC boiler, whatever the case may be, energy or water product infrastructure, you can now refinance those and get that equity out. And we have a couple of case studies where we've actually saved businesses during COVID because, for instance, the Strand Theater in Pontiac took out all this money anticipating, a beautiful venue for entertainment, and then COVID hits, there was no entertainment. They were able to save their business by using PACE, pulling out some of their equity because they'd already done those projects 2 or 3 years ago, and the business was survived, basically from PACE financing. So it's a great tool in these inflationary times in my mind.
That makes sense. Alex?
Yeah, so similarly, I think Lex is a great tool in the toolbox alongside PACE to go and to the point rework your capital stack, right? So if you have a need for capital, COVID hits, business interruption, whatever event may come up, you now, through Lex, have a way to, without having to sell your business, without having to sell your real estate, get rid of a portion of it, get partial liquidity, take chips off the table, realize fair market value for what you have, and then maintain control of the asset and have permanent non-voting capital be a new part of your capital solution and free up working capital for today. So, very, very proud of the solution we're able to bring to market and solve that from that sort of perspective. The other side of this as well, we've seen a lot of business as people are having to refinance their loans, people with floating rate debt, having to, deal with a different cash flow situation as they previously saw. There's an increased need for this kind of product, right? People aren't able to maintain the same sort of capital structure they were in yesterday's world. And the ability to not be forced to sell, I think, is a really key part because we all sort of see, there's probably some sort of downturn and there's definitely an upturn coming. People don't want to be forced to sell, and to give people that optionality to not have to do that, I think is a spectacular part of our solution.
Yeah, at Dwight, we have a unique program, which is the 35-year AM, 118 DSCR and 80% LTV, debt product. So in this time, we really shine just because our rates are typically about 100 bips cheaper than agency. It's a little bit more work to get through one of our products, but I think a lot of guys who have historically never looked at the HUD program before are forced to look at it now. It's really financial engineering at this point to make deals work. And one, really, beautiful tool about our product as well is there's an interest rate modification program. So 2-3 years down the line, where, if you lock something today or forced to do something in this rate environment, you're able to pivot later on to, readjust to those markets and that rate.
Yeah, absolutely. My line for HUD is the juice worth the squeeze. You have undeniably the best loan in the country. It's a little bit longer to get there, but a 35-35 with 10-year declining prepay is a pretty darn good deal with also the ground-up construction as well. The topic of the day is clearly opportunity here, and I know Gideon was talking about one of those opportunities being high leverage floating rate debt fund deals, bridge loans that were originated over the last couple of years. We're certainly a product of that. I mean, in order to get deals done on an acquisition side, we saw a lot of our clients just having to do 80, 85 LTC leverage, funding CapEx dollars, taking deals to value add levels, and kind of climbing their the returns that way by using very good interest rate debt fund executions. Actually, fortunate enough to close a $155 million bridge loan with Dwight Capital earlier this year. Was the last bridge loan that I did, and it was phenomenal work with them. Why don't we just take a minute to talk about that? I mean, clearly, with rates growing up, there's going to be a lot of conversation about these loans with short-term maturing caps, that their floating rates are no longer going to be hedge protected. They're going to see some widening of those interest rates, and folks are going to have to pivot, maybe do a recap, maybe blend in some PACE, or maybe put long-term debt. Would you mind just kicking us back off on how you guys are looking at those sort of bridge takeouts?
Yeah, bridge takeouts are difficult, in this environment right now. Everything, before, which was probably value constrained, is now severely DSCR constrained. So it's about, the right product with the, the right debt execution and what else you can pair it with. So at this point is really where guys shine. So if we can pair it with a PACE deal or a specific mezz product, it's the only ways to get deal done right now. And then, on our construction program, I know you touched on it's 85% loan to cost. So in today's environment, no one's getting even close to that. Again, we're going to be DSCR constrained at a 118. But yeah, I mean, it's a hard time for a lot of these bridge guys who didn't take rate caps. We're a balance sheet bridge group, so you said you've worked with us, so we're unique. We really want to have a good basis on all our deals. So I think we're in a good position, not like many of the other guys who are selling off a lot of their deals. But it's going to be an interesting time for all these takeouts in the next 12 to 18 months.
That makes sense. Thank you. And what debt fund were you at before, Alex?
I was in a fund called Oak North. So we were actually a bank in the UK, and then SoftBank came and wrote us a big check with a $100 million side pocket to go lever up for the US. So I was a part of that actually with Dan here in the audience, was our head recruiter for that. But I want to go to what Daniel was saying about DSCR constraints, right? I think in today's world, that is the problem. It's people don't have the cash flow to go and get through this. And as we sort of said, PACE financing and HUD financing are probably, not trying to rank, 1 and 2 cheapest options in terms of getting capital into your deal. But you do have that DSCR constraint. And I think when you're trying to go and balance your cost of capital with what you're actually able to bring in and constrain, having the ability to bring in extra equity is a key part of that equation. Because unlike debt, there is no DSCR constraint with equity. We'd love to see you pay cash, but there's no requirement to. And so when you bring in a Lex recap, yes, we're going to try to look at the cash flow prospects and the IRR prospects and the return prospects of a deal. We're going to negotiate that pricing, but you don't have to pay us in the same way, and it lets you rework your capital stack in a way that's compatible with these guys I'm up here on stage with to be able to play nicely with all forms of financing.
Thank you, Bob.
Yeah, I was just going to say, as an owner's rep, what we try and do is we try and find the proper vehicle with the bank and who else might be available to use PACE financing. And every bank's going to have different underwriting criteria in allowing, basically what is, first tax lien to come in on the property. So with PACE, it's a fairly new product. We do have to educate the banks. The banks have to understand that we're not really priming them. We're not really taking over there. PACE as a product does not have any acceleration. So even though it's a first tax lien, just like your real estate taxes, the banks are secured and the relationship stays the same. They can always pay the 1 or 2 years of taxes and foreclose on their property owners. So with us, it's really a lot of education of the banks and helping them understand that we're really not competition. We're actually buttressing and supporting that property while bringing in additional value, NOI, for that building or for that property. So yeah, it's a good time to be in this business because, again, money's more expensive. With inflation and building costs, PACE is a way to kind of soften the blow. And again, it may allow a building owner to hold on to their property, during the tough times we're in.
Bob, back to you. Can you walk us through the structure for those folks that are not intimately as knowledgeable on PACE as I know I'm not as knowledgeable as you are, of course, on the kind of the structure, the lenders that you're working with? My understanding, a lot of bank financing, which we do see. We're going to talk about opportunities here in the marketplace. We do see banks as a good opportunity for borrowers in the future. As the SOFR curve is going to start to come down, those banks are lending off of SOFR curves with swaps, so it should bear a lower fixed rate compared to the GSEs. So given that that's kind of your space you're playing in with your lenders, can you just dive a little bit deeper on how those benefits work and how you really structure that with that lender?
Right. Well, a lot of this is afterthought, which is, kind of, not the greatest scenario because you already have your bank in place, and then you have to work with that bank, obviously, if they've got the first lien to help them understand that we're not really competition. But on new deals, if the deal doesn't pencil out, we can go shop the market and find a PACE capital provider and, before the deal closes, make sure that they work with that bank. So a lot of it's kind of, getting everybody comfortable with the situation and helping them understand. But just to give the group here a little bit idea, PACE can come in up to 30% of your appraised after repaired completed value. So if you're building a $50 million project, you use up to $15 million of that for your roof, your windows, doors, elevators, anything that's energy and or water conservation related. Also let you take a closer look at solar, maybe geothermal. But the bottom line is a lot of this right now is kind of luxury and thinking about it. In 5 or 10 years, the rules are changing as we speak. So more and more cities, counties, and states are saying, hey, we want your building to be net zero. We want your building to have, really low carbon emissions. This is going to be a requirement, and PACE, in our minds, is the best place to look for that reasonable equity, and I should say it's non-recourse equity that you can bring in up to 25, 30-year term and, be a really good part of your capital stack.
Thank you. Alex, Daniel, opportunities in the marketplace you see today. We're living in times where we're having conversations with our clients on where the treasury is at that given moment, what their loan proceeds look like, what their deal looks like, their promote, et cetera, et cetera. What's keeping you guys busy? Where do you see the opportunities today?
Yeah, so I'm going to briefly tangent, right? There's a great meme poster that I've seen around. The beatings will continue until morale improves. That seems to be the Fed's approach at the moment, right? We're in a continuously rising rate environment until inflation is constrained. And inflation shows no signs of being constrained. So where rates go is an open question. I wish I had the answer. But with a continuously rising rate environment, it does create opportunity, right? I spoke on the last panel about price dislocation and price discovery. We're very much in that part of the market. We're equity investors here at Lex. Like I said previously, we have to sit in this sort of precarious position between the sponsor and the investor. We're trying to bring out a great investment product that has, a non-zero, hopefully a great return to investors, and also be fair to sponsors. And so we're sitting here watching very, very closely what rates are going to go do and trying to figure out how does that affect cap rates? How does that affect the ability to finance a property? Where are rates going to go? Do people have rate locks? Do they need to go and get new capital in a couple of years? And we're taking all of that into account as we're looking to go and price property and price risk. That is, at the end of the day, what we do is we're pricing risk and bringing that out to market. And by being fair and accurate and diligent pricers of risk, we're able to help people get out of situations that are unplanned, right? Unplanned rate increases, the ability to refinance or, the need to refinance where you didn't think you'd be stuck before. And we're seeing that create those opportunities. People who need to rework their capital stacks in a new environment they weren't predicting and find this new price level that works for everybody.
Thank you. Daniel?
Yeah, for us, historically, whenever there was a downturn, when the banks or, the funds shy away, HUD has really always stand still and, still lends at, market agnostic. Their terms don't change. So for us, it's really educating guys who have never looked at HUD in the past to understand the benefits of this product. Again, like you said, if you can get through it, it's the best thing out there. But it takes some time. We think we bring a lot to the table with early rate locks and bring some other creative things to the table to only enhance the product. But again, I think in this rate environment, people have to look into every single option to what that execution makes the most sense for every deal, and HUD is going to play a big factor in the future.
Thanks. And I'll jump into just from a Fannie Freddie perspective. So we're very active in those loan programs and happy to touch on those if you guys might have questions there as well. The liquidity market where deals are securitized and traded when those loans are sold off in bonds, which can be in the form of a bridge loan in the CLO market. It could be in the form of a CMBS loan, but also Fannie Mae, Freddie Mac, and HUD all secure, and Ginnie Mae all securitize their deals with those government guarantees. The most liquid market we're seeing still over time, as Daniel's pointing out, with some of the agnosticies to the market, there needs to be liquidity from our Fannie Mae, Freddie Mac, and HUD lenders. They're very driven on that. They need to keep loans liquid in a marketplace, eyes wide open with rising interest rates. Those allocations that come out from Congress every year are pretty flat. So we're still looking at, $140 billion of multifamily financing just from Fannie and Freddie. I don't know. I don't think HUD has an allocation. I think they just are wide open to do whatever you guys can do. But definitely is still the same promote that there needs to be loans available for their borrowers. There needs to be liquidity in the marketplace. And as those deals trade, because of that government enhancement, that's where we see the spreads being the tightest, with the tightest being HUD, of course. There's just a better structure there. So that said, what are you guys seeing on the credit side to try to push and pull these levers to keep things fluid? And then if I don't know if you're able to have any updates on PACE, if there's any movement there. But just to touch on the debt, how people are underwriting things. We've seen lenders come maybe from a 125 debt cover down to a 120. We've seen a lot of life insurance companies go to a 1.0 flat to get deals off the street, to keep production open. Can you comment on anything coming down the pike from HUD or how you guys maybe on your debt fund are trying to push levers on the credit side?
Yeah, I mean, on our balance sheet program, I mean, you got it done on the bridge side. We don't sell off our loans, so we stress rates, which obviously at this time is going to be difficult. So I think it's harder for us to get bridge deals done unless it's for the right deal. Historically, we tried to be at 80%, loan to value or loan to purchase with 100% of capex to just be aggressive because that was the marketplace. I think we've tailed off. We're probably maxed 70 to 75 with 75% of capex. On the HUD side, the terms don't change. So we're still at the 118 DSCR. If there's affordability components, you can go as low as 115 or 111. Also, very creatively on the affordable side, we can underwrite to hypothetical market rents. So for an affordable deal, our dollar for dollar compared to agency will be a lot higher. Again, there's a lot of hoops that you have to jump through, reacts. So a lot of times the Fannie Mae execution is probably the easiest. One thing that we discussed a lot before the rate hike was how a lot of the agencies were turning towards for a mandate for affordable. And I know that was not a proponent of HUD because, again, it could be affordable or market rate, but we saw that as a big change coming down, which sort of went to the wayside now with rates where they are.
Also heard a rumor that there's no more limit to distributions. You guys are open on the distributions now. Do you want to comment on that?
Yeah, so the three main negatives to HUD are the time it takes to close, semi-annual distributions, and the annual reserves with the REAC. So HUD has made some great changes this past year, one of them being that you're allowed to make distributions monthly. And then on the construction side, it was historically a three-stage process, concept meeting, pre-app, and firm app. All in all, I would say 12 months. Just because of the housing shortage, they're really pushing developers to do a one-stage or concept meeting straight to firm, which will cut out about 3 to 4 months, which is a game changer on the construction side.
It's big news. Alex, anything on your end that you guys are pushing, pulling on the credit to get deals done, recap standpoints, how you're looking deals?
Yeah, I mean, I think one of the bigger things that's on our mind, and I'm curious to hear how it affects you guys as well, is we're in the business of pricing risk, right? And the risk-free rate, as we think of it, is the 10-year Treasury, right? And so the risk-free rate keeps climbing up. And so as you're looking at cap rates and you're looking at rates of return on buildings and distributions, and how does that play into the return on equity you get when you enter into an equity transaction, the spread between what you're able to get and the risk-free has been compressing. And it puts us in a very difficult position as we're negotiating pricing and saying, how much more risky is this transaction than buying a 10-year Treasury bond? And we're having to turn stuff away because you're looking at, for example, we've got a multifamily deal in New York City. And multifamily in New York City is considered a great deal. But there are a number of elements to it that are, I won't get into the particulars, but non-traditional, where you say, okay, multifamily New York, maybe you say that's equal to 10-year Treasury or, approximately the same. But then you add in A, B, C, D, E. Wait a minute, I'm only getting a 30 bip spread on the Treasury, taking all this additional risk. That's a lot harder. And so that's a big part of how we're looking at stuff now and coming in and saying, what is the actual risk-adjusted return of this with a moving target on what risk-adjusted return is? And I assume from the debt side, because I looked at it in a similar way before, you guys probably have a similar look to how you're pricing, or maybe you don't. I'm curious to hear from you guys.
I'll jump in. I think you hit the nail on the head, and that's why I wanted to hit on the liquidity that the GSEs bring to the table. Yeah. There is some mission-driven business. Fannie Freddie undisputably want to see more affordable rents and try to maintain the affordability in the marketplace, but they're here to do deals. HUD, same thing, agnostic to that. Where we are seeing some pullbacks are from more of our discretionary lenders like life insurance companies. Those lenders obviously match assets and liabilities. They sell annuities for a living and life insurance product. If they can go buy a bond and it doesn't have a whole lot of risk and yields them the same return, why do a real estate deal? So I do think you're going to see some in and outs there. Banks, of course, historically will go in and out of the money as risks change in the marketplace and they can put their money to work elsewhere. So I certainly echo that, and we are seeing some pullbacks and long conversations with lenders on next year allocation. But I do think, Fannie Freddie HUD will be wide open.
Yeah, I was just going to comment, by using PACE in the capital stack, you're actually lowering the risk of the sponsor because instead of them going out to the mezz market or the equity market, with a higher interest rate, you're able to put into that capital stack PACE. Right now it's around 7%, sometimes a little bit less. It depends on the capital provider and the deal. But I also wanted to make the comment that PACE is a unique product, and it basically doesn't look at credit or risk. It looks at the property and what can the property return, because it's only looking at the property for recourse. There's non-recourse debt with PACE. So really interesting product, not as affected, I don't think, on the credit side as maybe some other products.
How do you quantify that risk? Do you have a debt calculation or a debt service calculation that you run based on NOI? How do you come up with your sizing?
Yeah, it's not me. It would be the PACE provider and then the bank that actually has the debt. And it's kind of a potpourri of different responses. It's looser when you look at the credit market. I should say the credit unions. It's a little bit looser because they're more into community-based financing, and they're also looking at projects that have this, great ESG quality to it, environmental social governance quality. So, we're actually looking at, more credit unions because it's a little bit looser. On the opposite side of the coin, the Comerica's of the world and those, traditional, bank financing, it's a little bit more difficult.
That makes sense. I'm going to leave some time open for questions here at the end, of course, and bring your tomatoes. I know we're not the most popular people on the stage today with rising interest rates, but before we go there, always fun just to end. You guys want to share just a good deal you've worked on this year? Give us a case study where your products came to work, a good success story. Bob, I'll let you start.
Yeah, I've had a few interesting ones. PACE basically can finance anything from $250,000, and there is no upper limit, but about $250,000 is the smallest one we did. We actually did a church in Detroit about a year and a half ago, that was really cool because it was an old church from the 50s. They didn't have the financing or the money or the ability to go out and get financing for upgrading the building. And, it's just really tough conditions inside for the parishioners. And, we brought in lighting, we brought in roof repairs, we brought in HVAC repairs, and, really, made that building, with all the deferred maintenance, we made that building kind of, come to terms again where people could enjoy it. And, that's one of the more gratifying things about being in this business. It's not just about, cash return. It's also about taking these buildings and getting them more sustainable, more resilient, and then also livable for those that want to use it.
Thank you.
Yeah, we worked on a deal, an industrial deal up in Nashua, New Hampshire, which is actually still sort of ongoing. So it's become, in the end, a multi-phase deal. But basically what had happened was we ran into a situation where a really great sponsor had taken something that was a really deep value add, 100-some-year-old building that had been truly mismanaged, came in with a very smart money fund out of the Midwest, and turned it around, and that smart money fund got an incredible IRR out of it in a much faster time frame than planned. And IRR management said, you know what, we want out, right? We've made enough money. There was still juice left in it. And we were able to come in and cash out that fund and provide this really unique opportunity out to a broad swath of investors. And what made it really a unique deal is we came at it from a Reg A perspective. We wanted to make it truly accessible to everybody. And and I've talked to some of you guys just sort of networking around, we got caught up with the SEC. SEC's, there's only one of them out there, and they're not always the most competent. And so one of their commissioners misfiled our paperwork in the early part of August, and the whole the whole desk at the SEC went on vacation. So for all of August, the entire desk was out of office. And our deal had a deal with their bank. They knew a local bank where they could lock in a 3.25% interest rate if they were able to raise money by the end of August. And we couldn't raise with Reg A because our entire desk at the SEC had gone on vacation. And so in the span of about 2-ish weeks, we converted the deal from a Reg A to a Reg D, just enough to raise the minimum amount required to go and be able to lock in this interest rate. So, multiple all-nighters from me and my team. We turned this thing around. I'm very proud of that. We have a few investors in that deal in the audience here today, which thank all of you for coming in. And now the desk is back. We're waiting on approval any day for this to go be a Reg A, and we'll be able to bring that deal out to market. And to Milko's point earlier, really cool. Industrial is an incredibly hot asset class we're in a market with sub 1% local vacancy, with a building that is more than 20% vacant, but still cash flowing in a very, I can't say exactly how much, but a very high, substantial amount of cash flow with all that vacancy. So a ton of upside left, a really spectacular deal that we're very lucky to have stepped into, and look forward to bringing to market in a fully accessible Reg A way shortly.
Thank you. Very cool stories.
Yeah, I'm sure like you, Aaron, the best deals are the hardest deals to get through. I just closed a deal in Florida. It was an affordable deal that had a B piece and a C piece with a HUD deal. REACT problems that thankfully we have a gentleman who we hired who wrote the HUD map guide. So we joke that getting a HUD deal done is going through the Amazon jungle. If you don't have the right tour guide, you're not getting it done. So we hired the guy who wrote the map guide. This deal from day one to unexperienced HUD borrower, so just walking them through that is difficult. With all the rate changes throughout the past year, get the firm commitment back. He comes back to me and says, I want more money. Like I'm getting an agency deal that's better. So we actually filed in a request to HUD after already getting a firm commitment to increase our leverage. And, they approved it. And then also it was in Naples. The day of closing was the day of the hurricane.
Oh my God.
So we just said, don't ask any questions. Just close. We had to get cell phone pictures from a couple residents because there was no internet or anything, that the roofs were still on. But again, those are the deals that are the best when, every day you think it's going to fall out, but you can finally get it done.
Very good. Thank you.